Hi guys, our topic for today is balance sheet. But first, what is balance sheet? Balance sheet is the statement that shows the financial position or condition of an entity by listing the assets, liabilities, and owner's equity. And it's also known as a statement of financial position. The balance sheet is one of the three main financial statements. The other two called income statement and the cash flow statement. The stuff that a business owns is equal to the stuff that the business owes. In other words, a business owns assets and it owes liabilities to third parties. The difference between the two is called equity, which is what the business owes back to its owners. And so we have the accounting equation. Assets are equal to liabilities plus equity. When we take a snapshot of this accounting equation at a single point in time, we're looking at the balance sheet. We call this one the basic balance sheet. As its name suggests, it's got to balance. That means that total assets must always equal total liabilities and equity. Why the balance sheet is important? If you want to start up, then you absolutely must be able to prepare one of these in order to have a hope of getting funding. And on the flip side, if you're ever planning or lending money to or investing in a business, then it's critical that you know how to read and understand the balance sheet, because the balance sheet will give you an impression of the business's financial health, and that will determine how risky the opportunity is for you. And finally, if you're an accountant, then chances are you'll be helping prepare one of these at the end of every accounting period. This is the format for balance sheet. For the first line, we have the company's name. Second, what type of financial statement are you preparing? And the third is period ended. And then assets. Under assets, paghihiwalayin mo yung current assets and non-current assets. So current assets is all the assets of a company that are expected to be conveniently sold, consumed, used, or exhausted through standard business operations within 1 year. Examples ng current assets are cash, receivable, prepaid, inventories, and supplies. While ang non-current assets naman are companies' long-term investments that are not easily converted to cash or are not expected to become cash within an accounting year. So, ipag-add mo yung current assets and non-current assets, yun yung magiging total assets mo. And then space, liabilities, ganun din, current liabilities and non-current liabilities, paghihiwalayan. So, current liabilities is the short-term obligations that are expected to be paid within 1 year, such as accounts payable. O yung pagkakautang ng kumpanya that is payable in short period of time. While non-current liabilities naman ay any debts or other financial obligations that can be paid after a year. O pagkakautang ng kumpanya na babayaran nila in a long period of time. Then, ipag-add mo yung current liabilities and non-current liabilities. Yun yung magiging total liabilities natin. Then space, owner's equity. So, ipag-add mo si total liabilities and owner's equity. So, that is total liabilities and owner's equity. The goal here is, kaya siya tinawag na balance sheet, total assets should be equal with the total liabilities and owner's equity. And now, let's proceed in how to make a balance sheet. First, you need another report called a trial balance. Trial balance is an accounting report showing the closing balances in all general ledger accounts at a point in time. Here's a trial balance for a dating app called TUMBLE. It was run at the end of TUMBLE's financial year, December 31. And it's an adjusted trial balance because all adjusting entries have already been posted. We can see all of TUMBLE's accounts and balances. Debits are on the left and credits are on the right. At the bottom, we can see that the debits total to $700,000, which matches the total credits exactly. This means that the TUMBLE's trial balance is in balance, which is very important because if the trial balance is in balance, then the balance sheet also has to balance. So next is, how do you make a detailed balance sheet? First, we need to divide TUMBLE's assets and liabilities into current and non-current. Cash, accounts receivable, other receivable, and prepaid expenses are all current assets. Property, plant and equipment, and intangibles are non-current assets. Accounts payable, taxes payable, accrued expenses, and deferred revenue are all current liabilities. And long-term loans is a non-current liability. In equity section, common stock is a type of capital contribution. And everything below that is retained earnings. These are TUMBLE's profits held for future use. Their opening retained earnings at the start of the year less dividends plus TUMBLE's net profit in the current year. And that's it. If we can pick up all these numbers and put them in our detailed balance sheet. So we got current assets $31,050,000 and $5.3 million in non-current assets. Current liabilities of $14.4 million and non-current liabilities of $1.2 million. Then we have $1,050,000 in common stock, which is a type of capital contribution, and then finally $19,700,000 in retained earnings or profit held for future use. Total assets are equal to total liabilities plus equity, so this balance sheet is in balance. So that's all for this vid. I hope you guys learned a lot and thank you for watching.